Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me live at Nasdaq HQ is Wade Guenther. He is portfolio manager over at Horizons ETF US. We're going to talk about, you guys might even know the ticker to this one, QYLD. It's popular out there right now as everyone is looking for options income within an ETF. Thank you for joining us. I'm super excited to talk about this product. So before we get into that, tell us about Horizons ETF and what happens to be your largest ETF.
Well, it's really great to be here, and thank you for having us. So Horizons ETFs is a wholly owned subsidiary of Mirae Asset, who's based out of Seoul, South Korea. And they are one of 3 ETF brands under the Mirae portfolio. And Mirae has about $340 billion in assets. And what they've done is they've given us a lot of intellectual and financial capital to make the Horizons ETFs brand here in the US become a significant participant in the marketplace. So the largest ETF is what you mentioned is QYLD, has about 160 million in assets, which is more than double what it was at the end of last year. So we're really seeing a lot of momentum and growth in that fund.
Right. Well, I love how many name these funds, right? The ETFs, with the YLD, so you're getting the yield. But I mean, it makes complete sense. Where else are you going to get any, right?
Exactly.
So RIAs, FAs are turning to the options market for that. But what is it designed to do, and how does this work?
So QYLD, again, is the Nasdaq 100 Covered Call ETF, and it owns all of the stocks in the Nasdaq 100 index. Mm-hmm. And it also writes a 1-month at-the-money call option on the Nasdaq 100 index. So what happens is it's designed to provide some income, 1 from the underlying stocks and 2 from the call premium. And also, because it's invested in the Nasdaq 100 stocks, it's supposed to provide some growth from those stocks because it still represents about 99% of the portfolio. Right.
Well, I mean, NDX, and for those of you that don't know, it's the top 100 stocks within the Nasdaq Comp X Financial. So that's where you're getting that exposure from your Facebooks, your Apples,
Exactly.
your Amazons, your Netflix, Alphabets, all that. So you get all that great upside exposure while also having the protection with the covered calls in it.
Exactly.
And do you think this has been successful because of a low interest rate environment?
We think that income is a very big problem in the marketplace right now, and it's because interest rates have been so low, as you mentioned, and have been increasing at just incremental amounts over the last few years. And we noticed that with fixed income investments, that the duration risks tend to cause their valuations to decrease when interest rates increase. So we see a lot of value in using call options as an alternative source of income. And we noticed this with QYLD because it's paid out about a 9% annualized distribution yield since 2014. And a lot of this comes from the 1-month expiry that we use, and we see a lot of time decay value that we're able to retain. We see that from the at-the-money position, we get a little bit more premium from that at-the-money versus a comparable out-of-the-money position. And then also writing, like you said, on the Nasdaq 100, it's a little bit more tech-heavy, has a lot more volatility than a comparable broad market, more diversified index.
Right.
And then lastly, we get about 1.5% from the underlying stocks themselves.
Do you think investors continue to shy away from options, or are you starting to see the FAs and RIAs that you deal with incorporate more of this into their portfolios?
We're not really sure if they shy away or if they gravitate towards options. But if they were to shy away, I think there's a few factors that could contribute to this. And one has to do with just options valuation in general. There's a lot of variables that go into pricing options. They're not always readily observable in the marketplace. And we ragdoll terms like delta and gamma around all the time with options. And they don't necessarily have a one-to-one relationship with the underlying stock. So it could be a factor. Also, again, at the time to expiry, options have a finite life, and we know that people have day jobs and they can't monitor their positions all the time as well as we can. And also, if there are certain risks with the amount invested versus the potential risks of the position, and let me compartmentalize this for a second.
Right.
If we're buying options, we're paying a premium, and there's a probability that we will lose all of that. It may not sit well with investors. On the flip side of that, if we're writing options, taking in this premium, then there is an opportunity, or there could be a risk of significant losses if the stock goes in the opposite direction of the position you're in, and the premium may not be that much to justify it. Now, if you want to use a bunch of option positions to help mitigate some of these risks, then you're entering into a bunch of different strategies that may be far more difficult to manage. But that's where we come in.
Right.
This is our day job. This is what we do. And we have a team of experienced options traders and professionals that are very good at managing these types of risks.
Well, this lends to the last question to wrap this up. Why is investor education for our FAs so important? It has to be continuous because the markets just don't stand still, and there's new product coming out all the time. So what are your advice to FAs out there when it comes to that?
Investor education is so important to us. We like to use partnerships with great firms like Dorsey Wright, who help us get to the marketplace with some of the education tools. We're actually having a webinar with Dorsey Wright on November 16th. Okay. And it's great because we're going to start with an options teach-in. We're going to tell people how options work, and they're going to come in and say how their proprietary technical models help investors choose when, say, certain asset classes are in a favorable investment period, and then to maybe tilt your portfolio a little bit heavier towards momentum stocks in that area and less on covered calls. And then when that paradigm shifts, then they will recommend maybe going a little bit heavier into covered calls. And we think these relationships are very important because they expose us to a much broader audience than we can get from ourselves. So these relationships with Dorsey Wright is just a prime example of how good it is for us to get the education message out there.
Yeah, that's a super solid webinar coming up. I'll have to definitely check that out. Thank you very much for joining us
Thanks
at HQ.
so much.
Traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.